Good morning, everybody. Campbell McCrary, Amvest Capital, live from New York City. Welcome to the Amvest Capital Inc. live webinar with Adventus Mining Corporation. Adventus trades on the venture as ADZN and as ADVZF on the OTCQX. Hope you'll enjoy today's program. Will also be available in on-demand replay. Amvest, of course, is a New York-based specialist investment management and corporate finance firm focused solely on the natural resource sector. And please note, this call is most definitely for informational purposes only. A few housekeeping tips to share with you. Some engagement tools. You can ask questions of management here. That's what's being highlighted right now. Important links and downloads, presentations there, and links to their website and stock price. And then at the very end, do please share your feedback. You can type that there at the end as we wrap up. So back to Adventus, Christian Kargl-Simard, President and CEO. And we also have with us Sam Leung, Vice President of Corporate Development. Welcome to the show. I understand, Christian, you've got some hot news to share from yesterday. So I'll let you tell us all about that. Then we'll circle back with Q&A.
Thank you, Campbell, and thank you, Amvest, for having us and introduction. So yes, yesterday morning we announced our eagerly anticipated feasibility study on Curipamba. Title says here, building the next major mine in Ecuador. So we should be up next after Lundin Gold's a very successful construction of Fruta Norte, and now that's cash flowing very well. Some forward-looking statements, I'll let everyone read at their leisure. By the way, this presentation is also on our website. Let's get into it. The feasibility study portion that we announced yesterday was on the open pit. So the first 10 years of mine life with an NPV8 using long-term metals prices of about $260 million after tax. We've also updated our PEA on the underground portion of this mine plan, which is years 10 to 14. That has about a 50 million NPV8, but note that is discounted from the time we start construction of the open pit. So that is very, very heavily discounted. If that was brought up to year 0, with the start of the open pit, you could triple or quadruple that NPV number. And we do plan to upgrade that PEA for underground to reserves in due course. But it just doesn't make sense for us to do it at this point because the project is so economic about putting this in production as quickly as possible. Our base case IRR using consensus long-term prices just for the open pit is 32%. At spot prices, it's 44%. We've got a greater than 1-to-1 NPV8 to Capex. Total Capex here is around $250 million with a $4.50 per pound copper price currently. That's a very financeable project. And we're currently in the process of arranging about $240 million of non-equity financing. So this is going to be one of the most geared projects you've seen, and that's because of the very strong margins on this project. What are those margins? So life of mine all sustaining costs of $1.26 a pound for the open pit. That looks at or converts into gold of $308 for gold equivalent ounce on an all-in sustaining cost basis, and 23,000 tons per annum of copper equivalent production, which works out to be 92,000 ounces of gold equivalent production. If you look to the gold producer producing about that much amount of gold at that all-in sustaining cost, best example I can give you is Wesdome. That's a 1 to 1.5 billion market cap company right now. So this is all about free cash flow here. This is a 10-year reserve currently with a 5-year underground mine plan with the potential to expand through exploration. In this company today, we've got around 25 untested or largely untested volcanic massive sulfide and porphyry targets that we'll continue to look at over the next few years. This is the cumulative life of mine free cash flow, looking at in the green, the open pit, feasibility study reserves, and in the gold, underground updated PEAs. Life of mine, using long-term consensus pricing, for $650 million US. If you compare this exact chart to Silvercrest Metals feasibility study in February of this year, we're more. If you look at Adriatic's recent feasibility study from a few weeks ago, they're slightly more using long-term prices. But those very good companies and projects are what we like to compare ourselves with. And we are, by the way, 100 million US enterprise value versus 500 and a billion in the cases of other projects. So we've got a long ways to go from a revaluation perspective and understanding of this asset in the market. And forums like this, as well as marketing consistently over the next month, I think will allow the stock to breathe and re-rate on the back of this. We used top consultants, both in Ecuador and on volcanic massive sulfide deposits to complete this feasibility study. It's important to note we have a single tailings dam for the entire life of mine, so it covers the open pit, underground, and any other new resources that we can put to the mine plan. So it's de-risks tailing significantly using the initial capex and then through life of mine. And now that we have completed the feasibility study and we'll have earned into the project, we can start looking at what did we pay for our attributable interest in the project. So we spent, this is forward-looking to the end of this year, $48 million over the last 4 years on project expenditures versus our attributable NPV, which gives us around a 0.2 times what we paid for our stake in the project. ESG. So part of the CAPEX here is connecting to the national grid. 90% of the grid in Ecuador is hydroelectric, so green energy. It's a small footprint driven by the high grades here. We are close to the deepwater port that will ship out of around 200 or so kilometers to it, primarily on the Pan American Highway. That's less fossil fuels burned to transport our products. But over 600 million investment taxes and royalties during life of mine, plus the multiplier effects. This is the main new mining project under Lasso government that can go into production during his term. And we've just gone through a few rounds of community consultations with the communities, leading to the filing of the ESIA, so that's the Environment Social Impact Assessment, which is expected to be done by the middle of November. 131 million shares out, that's been consistent over the last 18 months. 20 million Canadian in cash gives us an enterprise value of Canadian 120 million versus an NPV8 after tax in the combined open pit underground shown yesterday of US 308 million. Analysts are coming out with their new targets for the company after this feasibility study. In general, the target prices will stay in the $1.60 to $2.50 Canadian per share range. Unique shareholder base. So this hasn't changed from when I was last on. We continue to have the 4 strategic, financially driven investors. Nobis here is the large industrial conglomerate in Ecuador. They popped up with 3 million shares in the market over the last few months. We continue to have a representation across the world of institutional, strategic, and retail investors. Nobis is, in our view, the political risk insurance for the company, very supportive of what we're doing, hence they bought the shares in the market. And we look forward to working with them to get through all the permitting and start building this project late next year. The feasibility study was overseen by Dustin Small with a group of owners, team members that have built mines with Dustin in the past. Some of those become full-time employees when we build this project. We also have ring-fenced a construction team that will come into the company in the first quarter of next year after we've announced the project financing packages to take this project through detail engineering and then start construction late next year. So looking at the highlights now of what went out yesterday. So we got our maiden reserves on the open pit. Notice about 50% proven, 50% probable, so 6.5 million tons of 1.93% copper, 0.2% lead, 2.5% zinc, 2.5 grams gold, 46 grams silver. That's a 6-to-1 strip. A majority of these resources between 40 to 80 meters from surface. Then we have the underground resource, which is not all in the measured and indicated category, hence we couldn't do a feasibility study on it, but 2.7 million tons, higher copper grades here. So the underground is more copper dominant with some exploration upside around underground resource as well. We have a joint venture with our partner Salazar Resources. The deal is we have to fund 100% of the Capex to get into commercial production. Then we receive 95% of the free cash flow from the project, less 19.8, which is the sunk cost of Salazar prior to us getting involved. You have to add the $48 million we've spent to get to this stage, and then we revert to a 75-25% ownership. Because we're doing that heavy lifting on the financing side, we get 100% of the offtake rights, which are very valuable right now. We've got multiple groups looking to invest $50+ million as a combination of debt and equity for the offtake, for the right of the offtake. And we also have the right to arrange the financing options for the project, encumbering 100% of the asset, 100% of the cash flows, whether it be debt or streaming. And we've got a $200 million package on that front that is being finalized right now. Advances since the PEA. So very few companies go directly from a PEA to a FEES for good reason. In this case, we had strong definition on the resource in the PEA. We had a standout IRR in the PEA. We knew this was going to be a mine, so we skipped the public announcement of a PFS and went straight into this feasibility study. So key attributes over the last 2 years of work is we've infill drilled the project. So a lot of that reserve, or most of that reserve, is in the 20 to 25 meter spacing. We've improved the metallurgical recovery. So we've got very good concentrates now, 28% copper cons, 56% zinc cons, very little to no deleterious or penalties. It's only $4 million total of penalties on the concentrates over the 14-year mine life. But importantly, we've increased the copper and zinc recoveries on this project. We have a detailed mine plan here, bringing the higher grade material up front, maximizing the returns on the project. You will see the ESIA submitted shortly, and it'll be quite a detailed press release on that. We built this project on best principles, best practices, specifically when it comes to water, tailings, waste management. So we're using the best Canadian practices to complete that. And that has resulted in a large downstream conventional tailings facility, which has been designed with all of the inputs from geotechnical and hydrogeological drilling in this feasibility study stage. This shows you the NSR return on a yearly basis versus the copper equivalent head grade. As you can see, we start the mine at 7% copper equivalent in open pit. Also gives you the payable metal mix over life of mine. In the open pit, you're looking at 50% copper revenues using long-term consensus, 28% gold, 15% zinc, silver, and minor lead. More copper dominant in the underground portion of the mine plan. So about 80% of the revenues here are copper gold. That's exactly what the market is looking for. It's what the M&A, what's attractive and hot in M&A right now. There are very, very few copper gold development projects that are in a feasibility study in the world today. And if you look at rate of return for those projects, this would be the best rate of return of that bunch. A lot of questions about Capex increase. So in general, all of the attributes of this project are in line with the PEA, with the exception of taxes. Taxes are substantially higher. driven by modifications of depreciation and higher VAT and capital costs. So let me take you through this slide. On the mining side, because of geotechnical drilling, which you really only do in feasibility study stage or later, we determined that the materials of construction used in the PEA, which is primarily tuff material, are not adequate for construction of the tailings dam. We need fresh rock or andesite. So what we did here is we took a lot of material that was in the stripping over life of mine in the PEA that would have driven sustaining capital and moved it up to initial capital. So our sustaining capital costs are lower in the feasibility studies than the PEA. Secondly, on earthworks, this is primarily driven by process plant location. In the PEA, we had it on top of the hill. Because of geotechnical drilling, we had to remove the top of the hill, the saprolite and tuff material, and we have to build that process plant on competent rock. So that is an engineering result. It's not due to inflation. It's just really driven by geotechnical. Then you've got contractor indirects, which is always underestimated in PEA. So these are how many cranes do you need to bring into to build a project, what size of cranes, where are the contractors going to sleep, what kind of accommodation, those kind of things. I will point out, though, the project contingency has dropped substantially. This is a plus or minus 10% contingency project. It's the highest you can get for a project of this stage. And that's because of the level of engineering here, but also that the majority of the quotes in the Capex came from live quotes over the last 2 months, and a large portion of that from Ecuadorian contractors. So this is a very well-engineered project that is that our team is very comfortable taking to the next stage of detail engineering and building on. And it's solved all of the questions, comments on technical satisfactorily and from a risk-reward perspective. Project economics. So just looking at the open pit here, not the underground, which adds the 50 million in NPV to this. You're looking at a 259 million NPV8 after tax using consensus pricing, 423 million using spot, 32 versus 44% IRR. The first 6 years of mine life, at the consensus pricing, you have 495 million of free cash. At spot, it's 664 million versus the initial capex shown here, 248, and all the sustaining costs using the consensus pricing of $1.26 a pound on copper equivalent. This all drives an 1850 ton per day process plant for that 10-year mine life on the open pit. We're using the same 1850 tons per day to then process the next 5 years of underground. These are the final metallurgical recoveries with nice boosts to the copper recoveries and the zinc recoveries, producing very strong concentrates, and then the production, life of mine production is shown below. We have a conventional flow sheet, nothing funky, no new technologies, no fine grinding, producing copper, zinc, and a minor lead concentrate. So the timeline going forward, in a few weeks, we're going to submit our ESIA. That is expected to be an 8 to 12 month approval process, allowing us to start full-scale construction in the fourth quarter of 2022. Detail engineering is expected to start in the first quarter and run for about a year. Project financing, we talked in that press release yesterday of arranging up to 240 million of non-equity financing. We're going to continue to advance those packages with announcement hopefully by the end of January of next year. Investor agreement, so that kick-started last week with the Minister of Investment. We expect to have a resolution on the terms of our investment agreement by the end of the first quarter of next year. We will be able to draw down on project finance once the ESA is completed, once we start full-scale construction. We expect to do early site works on our project. So this is site clearing, grubbing, etc., installing the construction camp we bought from Lundin Gold, upgrading our roads. Most of that work can be done on existing permits that we have. And in the full-scale construction, it's expected to take 18 months. So we start in the fourth quarter of next year. Prior to the rainy season, you're looking at production in the second quarter of 2024. This is a picture of me shaking the hand of the president last week in Quito. We had many of the ministers required for project approval in that meeting, 90-minute meeting with the representation of our partners, Salazar's and our team in country. A very positive meeting. Red carpet to move this project forward as quickly as possible. And the ministers are well aware of our gating items. We've had several approved since that meeting. And we look forward to building this next major mine in Ecuador and being in production under Lasso's current 4-year term. Exploration-wise, it's near and dear to a lot of investors. We announced in August a new discovery at our Agua Santa target. We continue to drill there. We will have an exploration update not only on Curipamba Regional, but also on our Pijili and Santiago projects in November. And as a reminder, at Agua Santa, what we drilled is 4.5 kilometers away from El Domo to the southwest. We drilled 6.3 meters of 5.5% copper equivalent on 60 meters below surface, uncovering a new VMS system in the district. And we're just getting started on that side of things. Then we've got our big porphyry projects, Pijili and Santiago. At Pijili, just a recap over last year, we made a new porphyry discovery October 2020, 145 meters of 0.3% copper equivalent. We made a new skarn discovery on that same porphyry system, overprinting the skarn, overprinting the porphyry of 19 meters of 3.6% copper equivalent in April of this year. We have multiple additional porphyries identified in that district. We have been grooming them for drilling. Our most exciting one is called Pato. It's fully permitted, ready for drilling. We'll have more information on that in that November exploration update release. And we do expect to start drilling there in the first quarter or two of next year. And then there's Santiago. So this is what everyone is eagerly awaiting. We had planned to drill Santiago in the second half of 2021. We actually had a drill rig up on the project in August. The local communities around the project are supporting the drilling and our teams. What we ran into was issues still from regional, so not connected to the project, but regional anti-mining and indigenous groups. So these are groups 50, 100, 200 kilometers away from the project. We went back, we took the drill rig out in August, and we've gone back to the drawing board with the government as well as with the highest levels of indigenous leadership in Ecuador to build a better fabric there for us to get back drilling. So currently, our best case is that we're back drilling hopefully in January, but in the first quarter of next year. We have budget still to drill that 3,000 meters. We plan to do that hopefully, or at least get started drilling that hopefully before we need to go back to the market. Now, on that point, we're absolutely not doing equity financing this year, and we're not doing equity financing until we've announced a project financing package or packages and or announced an M&A transaction, which I'll talk about shortly. So in a best case scenario, we've announced M&A, project financing, market knows how much equity, if we're going the standalone route, that's left, very little. We'll go raise that sometime later in 2022, and hopefully we'll have results from Santiago, or at least started the Santiago drilling by then, and be at significantly higher prices as well. A reminder on the Pijili district. So here's Southern Copper, billion-ton porphyry in feasibility study. That feasibility study should be done in 2022. We made our 2 discoveries at the Mercy concession over the last year, as mentioned. The Pato target is here 7 kilometers to the west between our 2 concessions, Rosa de Oro and Carmen de Pijili. So this is a large land package that we're filling in around Southern Copper. At Santiago, still the plan is to drill 2 to 3 1-kilometer plus holes, partially twitting the historical Newmont holes from 25 years ago and going into this large geophysical anomaly with the view of having a billion-ton plus porphyry system. So to conclude, and as mentioned in the press release, management is currently reviewing strategic alternatives for the company, whether it be M&A, strategic investment, project financing, which could come in the form of 1 or 2 packages for up to $240 million of non-equity. We will pick the best plan for the company ideally by the end of January, but in the first quarter of next year. That's going to be very exciting for the company. Either an M&A transaction, and if it is M&A, we're focused on producers that have construction teams, experience operating in Latin America, experience with VMS, access to capital, cost of capital better than what we can arrange, and a compelling value on an M&A transaction. If we can't come to something that makes sense with a counterparty, we will build it on our own. And we're well down that track to be able to execute on that, including the construction team, and we'll get going on that detail engineering in the first quarter. So next 4 months, stay tuned on one of those outcomes, which I think will be, either way, very exciting for our shareholders. We have the ESIA submission very shortly. That should be our next press release. That starts the clock on the approval there. We have ongoing exploration on regional targets in Curipamba with an update on that over the next 2 to 3 weeks. And we have the detailed engineering to commence after we've announced we're going it alone, and we've announced the project financing packages. We have the Santiago target to drill in 2022, hopefully starting in January. We've got the Pato target to drill in 2022. Both very exciting company-making type of targets. In addition, we've got the joint venture of South 32 in Ireland. It's imminent for South 32 to be drilling in Rathkeil. That would be another release that we expect by year end. And on the back of this feasibility study, we will be doing extensive institutional retail marketing through November. So likely to hit 50 to 75 institutions with brokers over the next 2 to 3 weeks, telling this exact story and talking about how unique a copper development asset Curipamba is. And that's it, Campbell.
Okay. You ready for some questions? I've got a lot that have been sent in, and then our team is going to be asking them as well. All right. Given the new feasibility study with more of the resource moved to the proven category and the IRR at 34%, the opinion does not provide enough of catalyst for Adventus as a potential buyout candidate. What are prospective buyers looking for today for a transaction to take place? So I guess in a broad way, what do you think you need to do to fill his perceived gap?
Well, based on the interest in our data room from corporates, there's not a shortage of corporates interested in Adventus. As I showed previously, $650 million US of cumulative free cash flow using long-term consensus pricing is something that most copper producers would be interested in taking on their balance sheet. We actually have inquiries from $10+ billion market cap companies. Those are not solicited interests. Those are companies coming in and saying, look, generally, Curipamba has been too small, but in the light of $4.55 per pound price environment, this cash flow generation is pretty interesting. And this is a very doable project as well, and of course, it's cheap in the market. Perhaps as an interim step, we bring it on. We maybe set up a beachhead in Ecuador with an operating mine to grow from an exploration perspective. These are some of the largest mining companies in the world. I didn't expect that, but there's definitely not a disconnect here between the size of project and M&A, and I hope to prove that to you, or potentially can prove that to you over the next few months. 10 million tons of 5% copper equivalent, primarily open pit, is a money printing type of exercise. And as I mentioned, the best comps here, in my view, are Adriatic, which supports a 600 million Australian market cap, and and Silvercrest Metals, which is halfway through construction, supports a $1 billion market cap. Clearly, there's a lot of interest in those projects and have a significant institutional strategic register. So that should be the same in this case, and that's the re-rate opportunity.
Okay. Any royalty payments?
Yes, there's royalty payments. There's about $450 million of tax and royalty payments to the government of Ecuador over the life of mine. So the tax and royalty burden is over 40% here. That is substantially higher than other jurisdictions, but it is what it is, and the economics include all of those numbers. So 4% royalty to the government of Ecuador. On top of it, Altius Minerals Corporation, one of our largest shareholders, is a 2% royalty.
Very good. Another question just came in. Can you please elaborate on the $50 million of debt and equity you mentioned potentially related to the offtake and how this relates to $250 million non-equity finance? Can you break down the $240 million amount in various buckets?
Sure. So on the project finance side, we have a line of sight on up to $200 million of project financing with one group. On the next bucket, called the offtake side, we have 5 to 6 groups looking to do another 50 plus or minus a million into the company. The leading groups within that bucket are offtake groups. What they're looking to do is call it 30, 40, maybe even more of concentrate prepay. So this is debt that gets satisfied through delivering concentrates. And then those offtake groups also would have an equity component as well. So I think it's actually possible to say 40 to 85 million, or 40 plus potential in concentrate prepayment. But in principle, what we're looking at is 30 to 40 million of concentrate prepay plus 10 to 20 million of equity from an offtaker to get to the 250 in our base case. Anything on top of that would be equity. In order to get a fully financed project, including corporate G&A, et cetera, we're likely looking around 275 to 285, depending on where the final negotiations on VAT comes with the government of Ecuador. So simply a $200 million bucket project finance, 50 million offtake, call it 25 to 35 million US equity. We can sequence it in those stages. So we announced the 200 million, we re-rate in the back of that, announced the 50, primarily non-equity. Those two packages together fully finance our pre-development costs in 2022, as well as some of the full-scale construction costs. That leaves that final equity piece at our leisure sometime in 2022, hopefully at significantly higher prices. So again, no equity financing coming now. If we're going alone, we're announcing these pieces first. We're re-rating hopefully significantly above where we were trading or where we raised our last equity at, which is $1.27 Canadian a share. And then we'll consider our options for that final equity. That could come in as a strategic investment from a producer at a significant premium, or it could come from the market.
What are the cutoff grades of the open pit and underground mineral resources?
Yeah, the cutoff grades have increased since the PEA. So it was, I believe, $25 per ton in the PEA for the open pit. Now for the feasibility studies, around 30, plus or minus $1. And in the underground, I believe it was $100 in the PEA. Now it's 105.
What environmental precautions are you taking, and how can you distinguish your precautions from other mining interests in Ecuador?
So everything we've done here is done to the best practices and best technologies available. That includes the tailings design. We reviewed all technologies with KCB, and they have determined that the best technology for this project, in light of the seismicity of the area and the rainfall in Ecuador and specifically in our area is a conventional downstream design. And we've designed that conventional downstream tailings to the highest Canadian standards, so significantly above the Ecuadorian standards.
Is offtake finance a prerequisite for the regular finance, or are they unrelated?
They're unrelated.
Does your Curipamba financing strategy still include potential gold stream consideration?
This is textbook streaming, and Wheaton Precious Metals is a major shareholder. If we didn't do streaming, we would probably need to find a quick replacement to Wheaton on our shareholder register, which is obviously possible. But no, streaming is something logical to look at this project.
Okay. Can you comment on management ownership and any recent management buying?
We collectively own millions of shares as a group, as a management and board. I personally own about 2.4 million shares, options, RSUs. Most of that is shares that I paid for. This company is unusual as a junior mining company in that we are in blackout 10 months of the year on average for the last few years, whether it be exploration results, financing discussions, M&A discussions, feasibility study, new resource, etc. That's no different this year. Management and board have been on blackout since the beginning of February for a whole host of reasons. If we were not on blackout, we would definitely have been buying during the year. Altius ceased to be on our board. Brian dropped off in June of this year. So they're free to buy, and they've been buying in the market, including yesterday. We expect to be on blackout sometime in the hopefully near future on the back of some material announcements, and I'm sure we'll be back buying the market.
Very good. Pass this over to Adam Graff. Adam, would you join us? There we go.
Great. Let me flip back here. Hold on a second. So maybe you could give us a little bit of an update from the new feasibility in regards to the concentrates, the recoveries, and where the into what concentrates the precious metals are going, and to what percent for each of the different concentrates.
I don't have the exact numbers in front of me right now, but I'll attempt to summarize that. So in the feasibility study metallurgical program, lots of lock cycle tests and optimization. We maximize the deportment of precious metals to the copper concentrate. So that's actually much better than the PEA. Copper concentrate has several hundred grams silver in it, in like the 200 to 300 grams range, and the gold grade ranges, I believe, in the low teens. And in the zinc concentrate, you're looking at 300 to 400 grams per ton silver, with the gold grade in call it 8 to 10 grams per ton range. You can see overall recoveries for the precious metals are 52% for gold and 64% for silver. Those are slightly lower than the PEA, but the base metal recoveries are significantly higher. The concentrate quality is higher, and the overall NSR revenue driven through metallurgy is better than the PEA. Higher concentrate grades means lower transportation costs and more interest in the concentrates, etc.
Maybe you should have done a gold stream before you re-engineered, sir. That way you could have gotten better terms. So could you give us just to follow up on that? Can you give us just a ballpark idea of how much of the recovered gold and silver is making it to the copper con? Or is that too difficult because you don't have the numbers in front of you?
Yeah, I think of that 52%, you're looking at 30%, 35% of that 52.
Okay, so call it 60+% of the precious metals are making it to the copper con.
Correct.
All right.
Christian, there's a similar question as well. I guess included in the metallurgical recoveries, maybe you can go into a bit on the work that we've done from infill through the testing campaigns over the last year. Also a question related to that is, did we look at SART circuits as well for gold recovery?
Yeah, of course we wanted to maximize precious metals recoveries, but it's, polymetallic systems, you have to take everything in account. So this is, in my view, the absolute best we can get using flotation, using the best lab in the world, base metal labs for VMS. And DRA have got a fantastic processing team. So it is what it is, drives very strong economics. Are there ways to improve this using perhaps hydrometallurgy or other techniques? We've evaluated all of them: dense media separation, optical sorting, gravity, cyanidation, fine grinding. Most of those don't work. That is because a large part of the gold is microscopic and in the lattice of minerals that are not recoverable. So the only other route that we have found that could work, but adds substantial risk, construction risk as well, operating risk, is SART and cyanidation approach. So what is that? That's taking the tailings out of the flotation plant, blasting it with cyanide in a reactor, and then recovering the cyanide because you're using so much of it in what's called a SART circuit. It's going to add about $50 million of Capex. It does improve recoveries on the gold and silver side by up to 20%, and the copper by, say, 10%. But we do the economics on it. It's not more economic to start with, and then you add on the extra risk. Not worth it. That is an optionality through cash flow once we get into production, but with further test work, but not at this time.
Yeah, that was my question. Assuming that the preliminary numbers that you have for that work or are decent numbers, is there a rough gold price where you hit the break-even point and it makes sense to do, or will it depend on the timing of mine life remaining or something like that?
Yeah, we've done that analysis. You need to be in the 2000s dollar an ounce.
That's not far away.
If we were in Canada, like anybody on the call has run a SART circuit or is an expert, you will say that none of them have worked as planned. Some of them have worked, 50% as planned. They're very complicated. If you're in Canada, maybe you would venture into that if it was a break-even gold price. We're in Ecuador, and we're in COVID right now. It's just not practical.
Yeah. I guess I'm thinking about once you guys are up and running. Obviously, a couple years down the road, we could be at $2,000 gold next year, and so maybe you don't want to do it with the initial build. But
yeah, the biggest optionality on the project, in my view, outside of exploration and success, is just going back to this cash flow chart, and it's just the definition of 43-101. Because the PEA, because the underground was done on the PEA, because of indicated and inferred material, we had to put the underground production end of the life of mine. But that's not what we're going to practically do. This underground production is likely to come in somewhere starting year 3 or 3 to 6. And you're likely going to increase the size of the mill from the 1850s.
Christian, do you have a cross section, Christian, so we could see that the underground is not sitting under the open pit, or it's to the side, or I mean that would be illustrative, I think.
Not off the top of my head. It might be in here, but I can't remember if that picture is here. But yes, you're absolutely right. The underground is right next to the open pit, not underneath it. So it allows you to do that in parallel development. In order for us to put this properly in to this cumulative cash flow, we need to complete a feasibility study, which we've outlined in the press release. Is going to cost $8 million in a few years to infill drill. And then we need to apply for amendment to our ESIA. The ESIA that we're getting permitted is just an open pit. We need to apply for an amendment for the underground, which I think is just going to be administrative at that time. What that does, though, to the project is if we assume a scenario of starting underground, same time as the open pit, at 1,000 tons per day underground, and add $20 million more for Capex to increase the process plant. The tailings is got plenty of capacity for that underground already, so we don't have to add Capex there. It takes the NPV 8 to 371 million US from the 308, and the IRR from the low 30s to 37% using long-term pricing. That is not theoretical. I mean, obviously it's theoretical, but it is likely to happen. It's just a function of 43-101 and some more infill drilling. That is much more, in my view, tangible upside than the SART cyanidation circuit. And hopefully through all of that, we can turn 5 drill rigs on with cash flow, start really testing those 14 regional targets, and now we're sitting with 30 million tons of VMS rather than 10. I should also note that unconstrained, this lens is about 16 million tons of resource. But when you constrain the resource with the mining shapes, it's just over 10. So that's what happens when you go through a feasibility study and consultants and you put a feasibility study around it.
Question for you. At higher metal prices, can the open pit expand into the resource that's now considered underground?
Yeah, we looked at that, and there's more technical considerations than just pricing around that. If you expand the pit, you start removing that andesitic dome, which the underground sits under, and the strip ratio just balloons. So basically, the open pit is the open pit. It's fully optimized. Maybe a little bit of room at the bottom of the pit once you're mining down there, but it is what it is. The upside is from the underground.
Does the PEA have access to the underground from the bottom of the open pit or partly down the open pit? And so you'd have to redesign that for a separate access way, I'm assuming.
It does have access near the bottom of the pit, but from a technical perspective, you can drive and add it anywhere within the several hundred meter strike of that underground. It would add minimal capital. The capital to develop the underground is $37 million, assuming you're using the existing process plant. If you increase the capacity, you got to add capital to that.
The underground grades, are they roughly in the same? I understand they're a little higher, but they are in roughly the same proportion as the open pit grades.
Yeah, there's the slide showing the metal, payable metal mix, and on that slide you will see that the underground has a higher component copper compared to the other metals. So open pit, life of mine, payable revenue mix, 50% copper, 66% in the underground. And that's really driven by lower precious metals grades in the underground. I should note another upside.
Is that something that continues, that that sort of zoning continues with depth as you as you're seeing the the potential extensions of the ore body? Is that like an overall trend? Lower precious metals.
Yeah, for all intents and purposes, the resource is cut off at depth. It's not open, including in underground. Where the underground is open is laterally towards the east. That zonation I would expect continues to the east if we expand underground tonnage. It's just lower precious metals. The underground is primarily at kind of 25 to 50, maybe 60 meter centers. So we do need to infill drill that. When we infill drill the open pit, we got a boost in grade, in particular on copper. So I could see that happening on underground as well. But generally the grades underground are slightly higher as is than the open pit.
Yeah. So I could see why the underground grades, dissuade you from putting in a SART, even further dissuade you from potentially putting in a SART plant.
Yeah, I see where you're going with that. Yep.
Yeah. And
but remember that regionally, right? We could have new discoveries where there's higher precious metals content. So everything that's all on the table. Our focus right now is executing, building this thing, generating free cash flow, either as Adventus, Salazar, or as another company.
Could you talk a bit about your construction team? If you've already really gone down the path of building your own construction, in-house construction team, or that's something that you're sort of waiting for, to see if somebody takes you out beforehand or something like that.
This is why the next 4 months is so pivotal. We definitely want to stay on track with our discussions with the government, building this mine during Lasso's government, etc. So we can't wait forever. We got to get going on the detail engineering early next year. But within this 4-month period, plus or minus, it's the optimal time to be looking at M&A where perhaps there's a construction team ready to go or that experience in-house versus doing it alone. That said, our status quo is building it. So Dustin has gone out and identified the key people to fit our construction roles, many of them in country. So we've got 1 or 2 ring fence for each of the roles. We have done a process to select the EPC or EPCM constructor. There's one that is shortlisted. We're getting going on kind of the negotiations there. Also talking about operational readiness and all those kind of things. So we haven't been sitting on our hands, even though we've been flat out on this fees and the ESIA. We are thinking about putting all those pieces in place by the end of the first quarter.
When are we going to be able to see the full report? When is that going to be on CEDAR?
Yeah, the team started writing the sections months ago. I've asked the team to be in a position to file it on November the 30th. So slightly less than the 45 days that are required. But in the worst case, it's going to be 45 days from yesterday. So that puts you into early December.
All right. Let me throw it back to Campbell in case there are some additional questions from the audience. I know we got a pretty big audience.
Yes, we have a lot of questions. So, I'm going to pick 4 for now and maybe try and answer them quickly in the next 5 minutes. The ones I missed, if you're still burning for the answer, just email us and I'll get it over to the guys and you'll get it answered. Can you extend the underground resource or is it drilled off?
It is open to the east, arm wave, 1 million tons, plus potentially higher grade through the infill drilling.
Are your agreements with surface landholders completed?
We have acquired the majority of the surface rights, so everything covering the resources, the key infrastructure, etc., all the things that we were certain on the location going into the feasibility study. Now that we know the exact location of tailings, waste rock, etc., we're checking off the final land acquisition pieces. We've designed the whole project around pieces of land where we know we have a willing seller, and it's just a matter of price. So we expect to wrap that all up over the next few months. We have budgeted in our $10 million US to do so, a portion, and we don't see that as a rate limiting step to anything.
Can access to the underground be remote from the pit and can be developed independently from the open pit?
We talked about that.
Yeah. Oh, I got a lot of questions here. So what is the tailings grade?
I haven't back calculated it, but I think they're going at what's the gold grade in the tailings. So we're looking at 2.5 grams gold head grade, and we're getting 50% recovery. So there's about 1.2 grams gold in the tailings. That's enough grade for most gold mines, but that's microscopic, and that's not easy to recover.
A little more on metallurgy. Someone referenced in the past zinc wanting to report to the copper con. Have you been working on that? And if that is the case.
Yeah, I just cannot emphasize how good final metallurgical product we have here. Through all of the steps, all the consultants, it's as good as it gets. We talked about earlier the deportment of precious metals to the copper con over the zinc con. So we achieved the best thing we can do there. The other thing was, as the question is alluding to, can we get the lead and the zinc levels down in that copper con to a point where there's little to no penalties? So we've been able to do it down to a 6 to 7% combined grade, which attracts that minor life of mine penalty of a few $1 million.
Great. Want to thank everyone for tuning in, and please share your feedback. That's this box that just popped up and is highlighting right now. In interest of time, I'm going to pass it back to you, Christian and Sam, to give us a closing, to close us, and again, take us review of the kind of upcoming catalysts and any immediacy that you see for us investors. Thank you.
Yeah, thank you, Campbell. I just want to emphasize. I want to emphasize that this is, in our view, the top economics of any copper development project with a feasibility study wrapped around it in the world. We've got line of sight on permits and being able to construct this mine, start construction within a year. And this really stacks up to some of the highest quality mining projects globally, with, call it, plus or minus 10 million tons in reserves. Big value disconnect at 100 million US market cap versus what this study shows versus the peers. But we've got a pretty attractive runway here over the next few months, evaluating potential M&A routes versus financing it with limited equity dilution and getting going with that execution plan early next year. So next releases will be ESA filing, expiration update on our 3 projects, plus Ireland, and then the big corporate event. Is it M&A? Is it finance? How does it look? And I think that will clearly put in people's minds that this is a real project that is going to get built, and it's a unique one.
Great. Thank you, everyone. Replay will be available in about 2 hours. The original link will work for that, too, in our new system. And if all fails, make your way to amvestcapital.com/replays, and it'll be posted there in perpetuity. So thank you, everyone. Thanks, Christian. Thanks, Sam. Have a great day and rest of your week.